Welcome to Lane Gorman Trubit's Expanding Your Horizons webinar series. This webinar will focus on the manufacturing and distribution niche. We have great speakers from Pinecrest Capital who will discuss alternative financing, the future of your company. If you have any questions for our presenters or would like to know more about LGT, make sure to comment below or you can email us at askus@lgt-cpa.com. Make sure to subscribe to our YouTube channel for more content like this. Thank you for watching and enjoy the video. Hi everyone, it's a little past 3, so we're going to go ahead and get started. I'm Katie Lyles, the Events and Marketing Coordinator for LGT. I see some familiar faces in the webinar today, so thank you again for joining us. For those of you who don't know LGT, we're a mid-size accounting firm located in Uptown Dallas. We serve our clients with services in taxes, auditing, and assurance services. LGT is providing countless opportunities to gain CPE credit, and luckily we're able to offer some live events in the end of 2021. So make sure to follow our events page for more information on that. And I'm so happy to introduce Chad Corley, who works at Pinecrest Capital, to introduce his company and today's speaker. Chad?
Thank you, Katie. Appreciate it. Like she said, my name is Chad. I head up all the business development here at Pinecrest. So what that means is all the relationships that it takes to get these deals across the finish line. I help spread those and widen our net there, as well as develop the ones we currently have. So Barrett Kingsrider is going to be taking you guys through this presentation today, and he will take it away.
Thanks, Chad, and thank you, Katie and LGT, for having us on the webinar today. I hope this will be informative as we talk about sources of alternative financing in the manufacturing and distribution industries. Would like to offer, feel free to interrupt at any time, send questions into Katie. I think she'll kind of let us know if we have questions that come up during the course of the presentation. But want to make sure that we show you a comprehensive picture of alternative financing options. So let's go ahead and get into the presentation. First, a little bit of background on Pinecrest Capital. We're a middle market investment banking firm based here in Dallas. We've been in business about a little over 7 years now, and we focus on family and founder-owned businesses in a variety of industries. A lot of our work, obviously, in the manufacturing and distribution space. That are pursuing a capital raise, debt or equity capital raise, recapitalization strategies, or potential M&A opportunities. And we guide them through that process from start to finish. Our clients are typically, again, family or founder-owned or closely held businesses, and to 20 to 500 million in total revenue. I'm a lawyer by training, but I'm doing investment banking for over 15 years in this market, and you were just introduced to Chad. A quick snapshot, just for those who are not as familiar with investment banks. They come in different sizes and flavors, and just to give you a picture of where we sit and how we would describe Pinecrest, we deal in transaction sizes, again, typically 25 to 500 million of enterprise value. You can substitute that for revenue. And on smaller transactions, you'll often see business brokers who will work on deals, certainly sub 25 million, maybe sub 10 million of enterprise value. And then larger institutional investment banks typically kick off north of 500 million, sometimes north of $1 billion of enterprise value. And so our sole and exclusive focus is the core middle market size of business. Here's a sample of transactions that we've completed recently in the manufacturing and distribution space. And as you can see, they're kind of across industries, across asset classes, but a consistent theme of companies that were seeking capital or seeking M&A strategies in the manufacturing and distribution space. Let's go ahead and get into sources of alternative financing. And when we think of alternatives, we like to give kind of a full picture of the various options that companies have to pursue raising capital. We first think about matching the type of capital that companies should be raising and the source of that capital to what the needs are of the business. And when we think about kind of standard needs in the manufacturing and distribution space, oftentimes it's for growth purposes. You're looking significantly at capital expenditures, growth by purchasing new equipment or opening up a new manufacturing facility, perhaps upgrading a manufacturing facility or a technology stack or equipment. But it's typically asset-based. Also, certainly mergers and acquisitions, growth by acquisition to get into new geographic markets, or perhaps expand an offering from a service standpoint or from a product standpoint, potentially acquiring a competitor to consolidate market share. Numerous reasons on strategy on the M&A front. Recruiting and hiring. A lot of companies don't think about the fact that you can actually secure financing just to grow your overhead and expand the size of the business from the human capital perspective. And then, of course, scaling revenue. We're talking about working capital. Sometimes this gets into the off-balance sheet type financing options, but we're purchasing inventory, increasing marketing budget, whatever we need in order to focus on growth in revenue and help drive the growth of the business. And creative financing structures are available from a variety of sources. And you think of the typical capital stack starting at the top here on the screen: senior debt, moving on down to mezzanine debt, to preferred equity, and then down to common equity at the bottom of the capital stack. There are different flavors in types of each of these categories, and that's what we will talk through today and some examples of them. But there's also some other sources of financing that are non-traditional relative to your capital stack. Factoring of receivables, or capital operating leases, purchase order financing, etc. And we'll discuss some of these. The important thing is when we are working with clients to help them source capital or choose the right partner for them, it's really critical to understand the needs of the business. What is this capital going to be used for? How long is it going to be put to use? Is the impact to the business immediate? Is it gradual? Is it over time? Are we looking for a quick return of capital, or is it a longer return of capital? Is it collateralized, or is it higher risk? And so we factor all of those intangibles into consideration to determine what source of capital is really going to be a good fit for the needs of the business. We'll get into some specific types now. The one that everyone will be most familiar with, obviously, is an overview of senior debt financing. When we say senior debt financing, we're talking about your traditional commercial bank lender. And so just as a simple case study here, we have a plastics manufacturing company. And the scenario is this plastics manufacturing company is seeking to raise $20 million to consolidate some existing debt and purchase new equipment. And so what makes them a fit for a senior debt financing? And so when we think about what are some key areas that lenders will look at and diligence needs, and then some ideal characteristics for senior debt financing, banks will want to look at traditionally 3 years of company prepared financial statements, 3 to 5 years, let's say, but at least 3 years. Audited statements, if they're available. Oftentimes in core middle market, family-owned businesses, we don't see audited statements, and so that's just if available, but not a requirement. Projected financial statements, 2 to 3 years. How do we expect the business to perform, and what is the basis of that performance? Certainly, how are we going to use the financing, and how does that financing play into the projections? Understanding of industry trends. Are we in an upswing? Are we seeing headwinds in an industry? Is there additional risk? Call it third-party risk that's being placed on that company. And customer concentration and management's tenure and background. Customer concentration is an important one, as it just plays into what is the risk of performance of the business. How well can you validate and support those financial projections? And so, for example, if you have 50% customer concentration, then there is going to be much greater concern by the bank that your relationship with that customer will have an impact on the future performance of the business, as opposed to if your largest customer is only 5% of your total revenue. And then historical management KPIs. And this is a significant one. I mentioned it last because this is an opportunity for the management team to demonstrate to the bank how they operate the company, what data do they aggregate, how do they store that data, and then how do they use it to make decisions about the business on a daily, weekly, monthly, quarterly basis. And so what KPIs are you tracking? Who's responsible for tracking them? And how consistently does the business perform, and how much visibility do you have into that? Banks are very interested in financing and supporting companies that have great visibility into their own operating metrics and data and performance and information that is real time, and that business decisions are made off of real time data. And so if you kind of distill from that ideal characteristics for senior debt financing, we like to see minimum of 3 years of profitability and preferably growth in that profitability, stable and predictable cash flows. Banks don't like surprises, and they're not looking for upside. They're just looking to make sure they get their money back with interest. Minimal or limited existing indebtedness. So are we recapitalizing some existing debt, or do we have some other lenders in the equation that banks need to figure out how to play with and how to get along with from an intercreditor agreement standpoint? And of course, minimal exposure to industry cyclicality or high recurring revenue profile. So we don't want to see, banks don't like to see a lot of cyclical industries. If they do, then that's going to lend itself to lower leverage and taking lower risk on a business if they anticipate there's going to be swings over the next few years in that industry. And so the thesis for this company was just to upgrade a manufacturing equipment and consolidate some existing debt. When we kicked off this process and how one will typically work is 2 to 4 months length of time is an appropriate expectation. Of course, that depends on the readiness of the company to go through a financing process. When you get into the diligence needs and key areas of focus on the bottom right-hand side of the screen, how prepared is the company to deliver that information in a timely manner, in an easily digestible format, and then update it on a consistent basis. If that is in place, then typically 2 to 4 months to secure senior debt financing. Structures can vary, but what you typically see is 4 to 5 year type term facilities. Sometimes they can be interest only for a portion of the note. In this case, we had a 6-month interest only payment, and then 54 months of principal payments plus interest. And banks can flex to the needs of the capital. And so if you are acquiring equipment, have to put some money down to order it, and then pay as it's delivered, and then there's a little bit of setup time, and then some time to get that line up and running before you're really producing revenue. Typically, banks will recognize that you're not in a position to just start amortizing that credit facility immediately. You need to get a little bit of time to get your equipment up and running, and so you're generating revenue to be able to start making those debt service payments. Pricing on senior debt financing is certainly very attractive right now, but you'll see pricing in the current market ranging from high 2% range up to say 6%. So you can kind of assume an average of 3 to 4%. That can be at a prime rate plus 0.5% or 1%. Oftentimes you'll see a floor in pricing. This is an example: prime plus 0.5% with a floor of 4 of a financing that we secured for a client. And in the event that rates could anticipate to float down, which is not much of an anticipation in today's market, but if they do, then that's where you'll typically see a floor so that the bank can lock in their minimum interest rate. Key advantages are it's the most affordable form of capital. It's obviously non-dilutive, and so equity retains complete control of the business. There's no operating oversight or ownership from senior debt financing. And you've got predictability and known obligations. So these are your financing covenants, your ratios that you have to stay in compliance with on a monthly and quarterly basis. And from a disadvantages standpoint, obviously there's typical collateral coverage. The covenants that we just mentioned are going to be usually the most stringent from a senior debt provider with fixed mandatory payments, a lot less flexibility here. And so if you're looking for flexibility, the trade-off is interest rate. And this, of course, is your cheapest form of financing. Moving on to mezzanine debt. Mezzanine is a very broad category that just typically means the place between senior debt and equity. This can come in the form of subordinated debt, secured or unsecured, but sub-debt relative to a senior debt financing. Or it can come in the form of debt with some equity participation and equity type elements. And so we can discuss the various flavors of this, but there's a lot more creativity that can come into mezzanine debt, typically a lot more flexibility. But with flexibility comes additional cost. So you'll see interest rate go up as flexibility goes up and as covenants typically come down. So let's start again on the bottom right-hand side with lender diligence needs and key areas of focus. You're going to see a very same or similar diligence process to the senior debt financing route. Historical financial statements, 3+ years, audits if they're available. Financial projections, obviously going to study industry trends, look at customer concentration, all the same as before. Again, a considerable focus on management KPIs and how the business is managed from a data standpoint and how much visibility is there. And then uniquely, is there any sort of existing credit facility with a senior lender or any off-balance sheet financing that needs to be taken into account when they are considering how much leverage is comfortable and how much interest rate is comfortable for a business to assume and still service. The timing to close on this is typically 3 to 4 months. It can take longer depending on if there's more equity elements involved. It could possibly take shorter, but 3 to 4 months is a good average. And a scenario that we look at here is a regional medical device distributor pursuing mezzanine debt to fund a $15 million acquisition. Now, this company would have been open to senior debt financing, but the leverage profile of the business, that is total debt divided by EBITDA, was such that it would go beyond senior debt financing. The maximum that you will typically see, some industries will go beyond this, but you'll typically see for a senior debt financing is around 3 times EBITDA. And so you can consider senior debt financing sort of in the 1 to 3 times EBITDA range, and 3 is starting to get in the gray. When you think about mezzanine debt, you're looking for financing typically in the 2 to 6 times EBITDA range. And 6 would certainly be on the high end, but again, it depends on the industry. And it depends on the use of funds. From a mezzanine debt perspective, you have lenders that participate in the industry that still focus on some form of asset coverage. So they'll look to the collateral to see what base of collateral is there to kind of de-risk their position. But most of the time, they're looking for free cash flow and are looking to just provide a multiple of earnings in the credit facility. And so it's just cash flow financing. And you're going to be not fully collateralized in a mezzanine debt position, but that provides some opportunity, obviously, for some equity upside for these types of lenders. From a structural standpoint, you see typically shorter terms, 3 to 4 years is fairly typical, can be shorter, but more flexibility on terms there as well. So 6 months interest only, sometimes 12 months interest only. You're going to see lenders here more willing to be flexible on those terms to meet the needs of the business and to meet the needs of debt service coverage. And amortization schedule here is important as well. Whereas a senior lender, you're typically going to see a straight line amortization schedule or at least a small balloon payment at the end of a credit facility. With mezz debt, it's not surprising to see larger balloon payments, given that you're looking at shorter terms. and typically lower amortization schedule. And so you can anticipate anywhere from a 10 to 20% amortization from a mezz lender with a 3 to 4 year term, which means that there's still approximately 50% of the principal balance of the loan outstanding, 50% or less, by the time you hit the end of the term of this credit facility. Your key advantages, again, are principally flexibility and increased amount that you can borrow, and that you've got some better ability to manage your cash flow from lower amortization and certainly interest-only periods. Disadvantages, you're oftentimes still in control of the business most of the time. If there are equity provisions, they're going to be in a minority form or just warrants or some form of equity upside. It's certainly more expensive than senior debt, oftentimes 2 to 3 times more expensive than senior debt can be. But again, that's the balance for additional leverage and typically fewer covenants. And again, as we go, please let me know if there are any questions that come up, and you can shoot those questions over to Katie, and she can interrupt the presentation, and we can respond to those in real time. Moving on to preferred equity. And there are a lot of flavors of preferred equity. We're just going to really talk about 2 today, non-convertible and convertible. We'll start with non-convertible preferred equity. And understanding where this ranks in the capital stack. We'll flip back a few slides. And preferred equity is going to be below any form of debt and of course, above common equity. And so oftentimes, investors will think of non-convertible preferred equity as simply an alternative form of debt, but it is not covenant-based and has a lot fewer restrictions than your traditional, obviously, senior or mezzanine type lenders. In this case study, we're looking at a growing health and wellness brand, interested in finding a partner to provide operational expertise and some growth capital. They have either exhausted credit facilities, or maybe they're too young to really secure debt. Maybe the company's been around for 1 to 2 years. They're growing very quickly. They need access to this growth capital, but they're asset light, and so need someone who will invest in really the upside opportunity of the business and in the growth of the company. When we look at diligence needs, starting again on the bottom right-hand side, you're going to see, again, consistent requests across the diligence front, financial statements, projections, looking at support here. Market size and growth validation, you start to get into a lot more of the equity-focused considerations on due diligence. What is the real upside potential of the market? What are some of the third-party risks from a competitive landscape that can be applied to the business, and what are the opportunities there as well on the growth profile? And then corporate and other documents, management backgrounds. When you're investing in debt, you're significantly looking at the assets of the business and the cash flows of the business. When you're investing in equity, even non-convertible preferred, you are really starting to look at what is the background and the tenure of the individuals who are running the company, and how comfortable are you with not just their ability to run and manage day-to-day operations of the business, but really significantly to drive growth. Timing to close for any form of preferred equity is around 3 to 6 months. Non-convertible preferred looks a little bit more like debt, and so there's typically less focus and less diligence on the growth prospects and that side of the equity risk equation. And in this sort of structure, when we say non-convertible, we're saying that you're investing in a preferred equity position. So you're below all of the debt and a liquidation preference, but you're above the common equity. So you get paid back first before any of the other shareholders get paid back, and it carries a coupon with it. In our example here, we've thrown up an 8% preferred. You can see these coupons go anywhere, to mid-teens to sometimes high teens, depending on if it's a pure substitute for debt or if it's just simply bridging the gap between debt and equity. And the non-convertible function simply means that the investor is going to get their principal invested amount back plus their coupon plus any additional form of instrument that they put on there or term. For example, an exit fee once the preferred equity is fully paid back, either a flat fee or a percentage of the original invested amount. These are pretty favorable structures for early stage or fast growing businesses. If you're not really able to qualify for debt financing, but you're not really looking for common equity that is highly dilutive, or even convertible preferred equity, which is also dilutive, which we'll get to, then this non-convertible feature is very appealing, because from a borrower's perspective, it really does just look like debt. And we consider them to be borrowers. Let's move on to the convertible preferred. I think this is probably the most interesting in the discussion today, because you've got the greatest amount of flexibility and the most leeway from both the companies securing the financing's perspective and the investor's perspective. And you will see funds that are really focused on debt will participate in convertible preferred structures, and you'll see funds that are focused exclusively on equity participate in convertible preferred structures, because it really has elements of both. In this example, we're talking about an aerospace materials manufacturer with a new military contract. They're raising $40 million to support rapid expansion. And this is going to represent a significant step up in the growth of this business and a great opportunity. However, this company doesn't have the existing asset base to secure senior debt financing. They're not quite there from a total leverage profile standpoint to secure mezzanine financing. And so they're looking for preferred equity. Now, because this contract is going to significantly grow the business, and we would anticipate a significant growth in the enterprise value of the business, they're really not looking to go down the common equity fully dilutive route. And so preferred equity is a good fit for the situation. A convertible preferred allows for an investor to come into the business in more of a debt position. So they're going to be above the common equity in the capital stack. They're going to have a coupon, some sort of preferred rate of return that will be attached to the principal invested amount on an annual basis. And this is where the creativity in the structure can start to take place. And so investors oftentimes will say, we're looking for an 8 to 12% preferred, or we don't care as much about what the annual return is. We just want to make sure that we make a minimum return on our capital. For example, 2 or 2.5 times return on our capital. And that will justify the risk of being below the senior or possibly subordinated debt position in the capital stack. In this example, we looked at a 36-month loan that had a buyout function at 2.5 times the original principal invested amount, or it was convertible into common equity. And this is the nice feature that allows investors and companies that are securing the capital to bridge a valuation gap or a perceived valuation gap. So in this example, this investment is convertible at a $2.5 or $250 million post-money valuation. There may have been such a large gap here that an investor was considering this to be a $100 million company, and the company itself was considering itself to be a $200 million company. And such a bridge to gap that the conclusion is, well, let's not try to come to a conclusion on valuation. Let's kick valuation down the road. and let's give everybody the best of both worlds. And so from the investor's perspective, you get the security of having a first out position relative to the common equity. And you know that you're going to get 2.5 times your money, but you also have the option to convert into common equity at a $250 million valuation if, for example, the company was right and this new contract and the rapid expansion is going to justify rapid growth in the business and significant increase in enterprise value over time, such that you would rather be in the common equity, and that's where your convert feature comes into play. The typically largest areas of negotiation on these types of deals concern who owns the conversion right. And so you look at this as either an advantage or a disadvantage, and it depends on the rest of the terms. How much leverage are you putting on the business? How secured is the capital? How much risk is the investor taking? And if the investor is taking quite a bit of risk and doesn't have a strong enough return on their preferred, then they're going to want to own the right to convert into that common equity. And this is what you see more often than not, is that it's up to the investor to determine at a set point in time or during or inside of the term of the loan, if they stay as a lender and simply get their 2.5 times return back in this example, or if they have the ability to convert into common equity at the $250 million post-money valuation. Of course, the analysis simply comes down to what puts you in a better position as the investor. And if you think the company is worth well north of $250 million, you're likely to convert into common equity. If you are simply looking to get your capital back and you're happy with the return, or if the company has not experienced the type of growth it was anticipating and enterprise value has stayed fairly flat, then you have the option of staying in your preferred position and simply receiving the 2.5 times return on your original principal invested amount. So I think that the biggest thing to note here, and from an advantage standpoint, is the flexibility. And it's best used when you have a lot of interest from an investor, but there's a really large valuation gap between company and investor, or just when the situation dictates that the company believes that it can outpace its valuation at present time with the growth that it can achieve from this investment, and is willing to take the risk on the higher return of invested capital in order to get the benefit of the limited dilution. So we covered a lot in this section, and before we move on, I just want to make sure there aren't any questions specific to convertible preferred equity. I think it's worth noting from a diligence process perspective and an underwriting perspective, your investors are going to act a lot more like equity investors in this scenario than act like debt investors. They're going to underwrite the business from a growth standpoint and consider what the potential return could be if they were coming in a common equity structure. And then the preferred equity route is typically, again, a means of bridging a valuation gap or of balancing out that risk equation. But that diligence is really going to focus on understanding the market size, validating the growth story, making sure the management team is sufficient to meet that growth trajectory, or that they have a good plan in place for how they are going to achieve the plan. Moving on down the capital stack to common equity. This, of course, is the highest amount of risk that an investor can take, highest potential return that an investor can make. And for a company's perspective, we oftentimes see common equity when you're thinking more in terms of a partnership. And so a company is going to seek common equity when the risk profile of the investment is such that debt is not suitable, and it would not support debt. And if it's not asset backed, for example, and if you're just really investing in growth with unknown potential returns, you can see the opportunity, but it's really tough to quantify to the point where you can take much risk out of the equation. Starting again on the bottom right-hand side, diligence is you're going to see some very similar diligence processes to preferred equity, but the focus here is typically a lot more operational and a lot more third-party validation. And so we'll jump right into KPIs. There's going to be a deep dive into historical KPIs. How does the company and how does management run the business on a day-to-day basis? How are you aggregating data? How is that indicative of business decisions going forward? And then from the investor's standpoint, typically institutional investor, how are they able to receive and digest this information and then provide value back to the company through a review of their historical KPIs and recommendations that they can make? Because you have to think from the lens of an institutional investor, they are looking at a lot of transactions. They're investing in some of them, and they have to manage and maintain those investments at the same time as continue to put capital to work. And so they want to invest in companies that they can get their arms around fairly quickly, and they can maintain a high degree of visibility into the performance of the business with a limited amount of time. So that just means really good access and ongoing access and visibility to financial performance and operational data and KPIs, so they can have a good sense of if the business is trending in the right direction, or if on a red, yellow, green basis, if it's trending more to the yellow or more to the red, where they need to get more involved and spend more time. So significant amount of diligence on KPIs and data visibility. Here we also step into a lot more analysis on future M&A opportunities. Now, how is this company going to grow? Is it growing through pure organic growth? Are there potential acquisition opportunities to expand markets or expand service offerings? What's the upside potential of those? And is there any sort of multiple arbitrage? So for example, if you're investing in a business at a 6 to 8 times multiple, you're going to look for M&A opportunities that are in the 3, 4, or 5 times EBITDA valuation range, so that those acquisitions can be accretive to the platform. The more acquisition opportunities there are that are accretive, then typically the more appealing the business is to invest in on the common equity side. And these equity investments, we typically look at them simply as control recapitalizations or minority recapitalizations. Control, obviously, the investor is acquiring a greater than 50% stake in the business. Non-control, typically less than a 50% stake in the business. You can still see minority equity investments that have control features through partnership agreements, but traditionally your minority equity investors will not have decision-making authority and control over the business. In this example, we're looking at a nutritional supplement manufacturing company, and they are interested in selling a majority stake in the business to a private equity firm and transitioning out of the business over a 1 to 2 year period of time. This is a fairly typical story for businesses that have reached an inflection point, and for owners that say, hey, I've got a lot of my personal net worth tied up in this business, and I'm looking for some liquidity. I'm also looking for a growth partner, but I don't want to grow off of my own balance sheet anymore. I don't want to provide personal guarantees on my senior financing. I don't want to be the one taking all the risk. And I also don't want to be the one necessarily making all of the decisions, because you reach a certain size as a business. And to continue to grow, you might think about expanding geographically or doing some acquisitions, but you've never done that before. And so in those circumstances, it can be great having an institutional partner come in, provide for a liquidity event, and sit alongside of you on a board level perspective as you're making decisions on the ongoing growth of the business and how to invest capital. The thesis here was to certainly secure a strong valuation, to realize the value of management's invested time and effort, and obviously the owner's time and investment, but also to secure a great partner for the business from a growth standpoint. Most of the time, these opportunities will have, or these types of companies will have significant growth opportunities, either organically or through M&A. And so having a great partner and an institutional equity participant to help drive that growth and take advantage of those opportunities is pretty critical. It's much more so than just passive equity that is simply there to write checks. Timing to close, 6 to 8 months is an appropriate time frame. These can certainly take longer, depending on how well prepared the company is to go through a common equity recapitalization process. But 6 to 8 months is right. And valuation is almost always based as a multiple of trailing 12 EBITDA, or sometimes run rate EBITDA performance, maybe trailing 3 months or trailing 6 months, depending on the industry, and if the circumstances justify looking at a company on a run rate basis. From a what is that multiple of EBITDA standpoint and what is valuation, it really depends on the individual business characteristics and certainly the industry that they participate in. And of course, above all else, it depends on supply demand in private capital markets. If you look at valuations today, there is a significant amount of capital available, over $3 trillion in private capital markets between private equity funds and private debt funds. And those funds are all competing for the high quality transactions. And so when those high quality transactions come to market that have above average financial characteristics, you're going to see an increase in valuation due to an increase in competition for those companies in those recapitalizations. But we're seeing, consistently in the manufacturing space, valuations have been plus or minus 6 times for forever. We're seeing those valuations go up materially in the last few years. In the last few years, last 5 years, let's say, you can see a traditional manufacturing business go for in the 6 to 10 times trailing EBITDA range, depending on size and risk profile of the business. From an advantage standpoint on common equity, your partner, especially with the availability of capital, you're more picking partner these days than your terms. Your partner is highly incentivized to support the growth of the business, and so you can see them as really an expansion of not just the ownership group, but of the management team. And you're bringing sophisticated backgrounds to the board to assist in decision making. And then there's certainly the opportunity to roll equity. In a control equity recapitalization, you're typically selling 60 to 80% of the business and you're retaining 20 to 40% of the business. In a minority equity position, you can just flip that. You're selling 20 to 40%, and oftentimes you're seeing that that capital go partially as just a straight liquidity event to shareholders and partially as capital on the balance sheet for growth purposes. From a disadvantage standpoint, compared to alternative sources of financing, this is where you experience the greatest amount of dilution and you give up the most amount of control. In a control recapitalization, obviously the equity partner coming in a majority position is going to take over all of the rights that the majority owner typically has, which would be the ability to raise debt, the ability to raise equity in the future, the decision whether or not to sell the business, or any major operational decisions that you can think of. So retention of control is significantly tied to how much equity the owner is retaining as a result of the recapitalization. Moving on, and we have just a few minutes, so we'll move quickly through these. The more asset-specific forms of alternative financing, there's a number of them. We're just going to look at 3. The first of which is equipment financing. This would be a fit for a company, in our case study here, a regional manufacturer of branded and private label food seeking $50 million to fund new manufacturing lines. This company was a very high growth business. And has been in business for a fairly short period of time. So it doesn't have the type of history that is attractive to lenders, either on the senior or mezz side. and they're growing so fast that they're really not interested in the dilution that comes along with common equity or some of the potentially dilutive terms that come along with preferred equity. And they're really just looking to finance equipment acquisition. And so you can look to equipment as its own asset class and as its own collateral class. And there's a number of equipment lenders that are in the market that solely invest in financing of either purchase of equipment or potential capital leases of equipment. The thesis, of course, is to significantly expand your manufacturing capacity. And when you're looking at off-balance sheet financing, it's usually faster and a little easier to secure. In this example, it's 2 to 3 months, which is fairly typical to close. The structure, depending on the form that this financing comes in, can be 3 to 5 year term, whether it's a straight line amortization or comes in the form of a capital lease, where you're leasing the equipment until the end of the term and then acquiring it for some nominal dollar amount. Usually, you can structure this to have different forms of tax benefits and considerations, and that's just a balance of cost and of course benefit. Pricing usually in the 8 to 15% range. Depending on what the collateralization is and how much of the fair market value or what percentage of the cost of the equipment that you are seeking to finance. From an advantage standpoint, this is certainly an asset-light solution. It's traditionally off balance sheet, not always, but traditionally off balance sheet, flexible, and typically quite fast. And whether or not it's off or on balance sheet really just depends on the ownership of the equipment. Is it something that you are leasing over time and you're financing the lease obligations, or are you actually taking ownership of the equipment where it will sit as an asset on your balance sheet, and then therefore obviously the liability will sit on your balance sheet as well. From a disadvantage standpoint, it's really cost. It's just much more expensive than what you can secure in your traditional senior debt financing. Oftentimes, the collateral goes just beyond the equipment, and so you're not going to usually see 100% cost of equipment financing. Usually, it's in the 60 to 80% range. So there will be some equity requirement or some additional collateral requirement, and you may be looking at some covenants here as well. Quickly covering the remaining two: purchase order financing and receivables factoring. In purchase order financing, the lenders who participate in this are looking to secure a purchase order, typically from a credit-worthy off-taker. And so in our example, we have a growing home decor distributor that's looking for $10 million in PO financing to cover supplier costs for a very large client order. The lender is going to want to know, who is that client? How often have they ordered from you? What's their payment history? What is their credit worthiness? Is this an order that we feel comfortable lending against because, it actually can act as collateral and we feel sure that it's going to be paid off in accordance with the terms of the PO. Typically 80 to 100% of supplier costs for the PO financing. And so your equity, so to speak, is your profit in that purchase order. And usually you're looking at 2 to 3%, call it 3% per month on utilized funds. So very expensive, but you're again, the way you should think about this is just investing at a margin from a product standpoint. So if you have high margin products, this can be a good fit. Lastly, receivables factoring. These are for companies that either aren't really suited or prepared to go through a traditional senior debt financing, or just looking to get value for their existing receivables quickly. And you can typically secure, around 80% of the invoice amount on a monthly basis at a cost of around 1% a month, plus or minus, again, depending on terms, industry, and the creditworthiness of the receivable. So now we covered the last three sort of quickly, but wanted to wrap up with enough time for questions. So any questions we can address over the course of the presentation?
We actually do have a question on preferred equity, but I feel like this could probably cover any of the different types that we talked about today. So, how would someone go about initially finding a person or reaching out to someone who would invest in preferred equity in their company?
It's a very common question, and I think it depends on the size. And that depends on the nature of the investor. So let's make it easy, and let's say it's a less than $5 million or maybe less than $10 million investment. For less than $5 million, that's going to be typically a family office or a high net worth individual who has a background in the space, maybe has a relationship with the owner of the company, or certainly has a very good background in the industry. And that's going to be, more relationship based. Oftentimes those are syndicated. If you're looking to raise $5 million, maybe you get 5 people to throw in $1 million each, and they share the risk that way. Once you get up to 10 million, or certainly north of 10 million, now you're in the institutional equity markets. And these are funds, committed funds, who invest in these defined structures of investment. So preferred equity, or certainly common equity. The best way to source those is through an investment banking firm like a Pinecrest, to have as an intermediary to go market your company and market your investment to a myriad of potential investors who actually are looking for investments in your industry for your size company at the dollar amount that you are seeking. So typically owners who try to do this on their own, they can talk to, 3, 4, 5 types of investors, where investment banks may go out to 100 or 200 institutional private equity or family office type investors. And so I think, having someone in your corner who understands the needs of the business and understands strategically how the capital will influence and impact your business, and can help guide you on what form that capital should take, how important is your partner, or how important is the provider of the capital? Is it just passive capital, or is it going to be active, where the nature of that partnership is really impactful? That can dictate the type of process that you run, and how you market your company and that type of investment. And the more people you market to, typically the higher the degree of competition, the better terms you have, and the more options you have for partnership.
It kind of sounds like you can do it on your own, but you're going to spend a lot of time doing it.
Got it. You certainly can do it on your own. We've seen people do it, but the best way to raise capital is when an investor knows that they are competing with other investors, because then there's pressure to invest because they don't want to miss out on the opportunity. There's sophistication in the structure because they're competing with other investors. And if that fear or concern of losing the opportunity is omnipresent, that's when you're going to typically see the best terms really come out of the woodwork. And it helps drive the process to a conclusion. If there's no real process and no real competition, then what is the impetus to return the phone call or to return the email? Oftentimes you see those drag on for longer periods of time when it's just sort of one off. But there are certainly opportunities to research and find funds on your own, to directly reach out to them. If you have a package of information that's well prepared, that you're able to share, you can typically find a business development professional at a fund. If you can find a fund that fits the type of capital and the type of industry and the size you're looking for, you can reach out to that business development professional who will connect you with an underwriter, essentially, who can start going through diligence on the company, and you can manage those processes on your own, if you have access to the databases that help you source and find those institutional capital providers.
Well, thank you so much for your time today. We still have time for questions, so please input those. And we actually have one in the chat now, so I'll go ahead and do that. How would doing a smaller financing now affect me if I want to sell my business in the future?
Sure. Great question. Very common consideration. Most of the time, it's just going to affect you based on the cost of the capital. If you're looking at senior debt financing, for example, it's going to have no impact on you. You'll just have to pay off that debt in the future when you sell the company. If it's mezzanine debt financing that doesn't have any sort of equity-like instruments, or it's maybe a small amount of minority equity, then it really doesn't affect you in the future, except that you will have to pay off that financing when you sell the company. And then you have to determine if they're also going to participate in any sort of equity instrument, if there's warrants or if any sort of common equity conversion or participation, and they're going to be in your cap table. Where that really starts to affect you is if they have any sort of decision-making authority or negative covenants in your credit agreement. So, for example, a negative covenant would be you cannot sell your business without our consent. Well, that would obviously wildly affect your ability to go sell the business, and you'd have to make sure that you're aligned with your investor. But usually, if it's smaller financing, which would be debt or some form of minority equity, it should not affect much of it certainly shouldn't affect your ability to sell your company. And the real impact is just going to be who gets what at close and what sort of dilution do you experience in your closing proceeds of the transaction.
It's a great question. How can people get in contact with you if they have any additional questions after this presentation?
Sure. Our firm is Pinecrest Capital Partners. We are based in Dallas, located in Preston Center. And our website is pinecrestcap.com. And our contact information is also on the presentation there on the very last slide. And you can reach out to us directly at any time, and we'd be happy to help.
All right. Well, thank you again for presenting with us. We really appreciate it. Thank you again for joining us, and please let us know if you need anything. Have a great day.
Thanks, Katie.